3 weeks ago, a 52-year-old woman named Laura made her final mortgage payment. The balance hit zero. The house, worth $675,000, was officially hers. No bank, no monthly principal and interest, just full ownership. Her friends congratulated her, her family called it a milestone. Financial advice circles would label it a victory. Last Tuesday, her air conditioning system failed. The replacement quote came back at $11,000. Laura has $4,200 in her checking account and $18,000 in savings. Paying for the repair outright would nearly wipe out her emergency fund. So she did the only practical thing available. She called her bank and applied for a home equity line of credit. 3 weeks after becoming debt-free, she went back into debt. On paper, her net worth is roughly $693,000. In reality, she cannot cover an $11,000 emergency without borrowing. She traded liquidity for equity, and the equity cannot keep her house cool in July. That is the uncomfortable side of mortgage freedom nobody talks about. The equity trap nobody warns you about. There is a powerful belief in personal finance culture that a paid-off house equals security. Eliminate the mortgage and you eliminate risk. Remove the monthly payment and you remove stress. Own your home outright and you win the game. That story is emotionally compelling. It feels disciplined and responsible, but it is only half true. When you aggressively pay down a mortgage, you are moving money from liquid form into an illiquid asset. Home equity is real wealth, but it is locked wealth. You cannot swipe equity at a grocery store. You cannot transfer it instantly to fix a car. Accessing it requires either selling the property or borrowing against it. Both involve friction, approval, and sometimes higher interest rates than what you originally had. Laura owns a $675,000 asset. That asset does not pay her property taxes. It does not replace her air conditioner. It simply sits there, slowly appreciating if the market cooperates. The security feels solid until you need actual cash.
The liquidity crisis hidden in plain sight. A 2023 survey from the Federal Reserve found that 37% of Americans would struggle to cover a $400 emergency expense without borrowing or selling something. What that statistic does not break down clearly is how many of those households technically have high net worth tied up in their homes. Laura is not financially reckless. She is not overspending. She did exactly what debt-free advocates recommend. She eliminated her mortgage as fast as possible. Yet she cannot comfortably absorb a 5-figure repair without stress. This is what I call the equity trap. You feel wealthy because your net worth is high, but your financial flexibility is low. You look stable from the outside, yet a moderate emergency forces you back into debt. True financial resilience is not just about what you own, it is about what you can access. The math of opportunity cost. Let's examine what aggressive payoff actually cost her. Her original mortgage was $320,000 at 4.2% interest. Over the last 5 years, she paid an extra $1,000 per month toward principal. That is $60,000 in additional payments beyond the scheduled amount. Now imagine she had kept the mortgage on schedule and invested that $60,000 gradually into a low-cost index fund, tracking something like the S&P 500, which has historically averaged around 8 to 10% annually over long periods. Even assuming a conservative 8% return, she could have around $75,000 to $80,000 in liquid investments today. When the air conditioner fails, she writes a check from her brokerage account. No stress, no new debt, no approval process. Instead, she saved roughly $13,000 in interest by paying down the mortgage early, but potentially gave up significantly more in market growth and, more importantly, flexibility. Opportunity cost is invisible. You never feel what you did not earn, but it is real. Paying off cheap debt to borrow expensive debt. Here is where it becomes even more ironic. According to data published by Bankrate, average home equity line of credit rates in recent years have hovered well above older fixed mortgage rates. Laura eliminated a 4.2% mortgage. To access her own equity for the air conditioner, she may now borrow at 7% or more. She paid off low-interest debt only to potentially take on higher interest debt later. This happens more often than people realize. When liquidity disappears, any emergency forces borrowing on whatever terms are currently available. The original interest savings get partially erased by new interest costs. The goal was freedom from debt. The result was debt under worse conditions. The cost of missed opportunities. Liquidity is not just about emergencies, it is about opportunity. Last month, Laura was offered a chance to invest $35,000 for a minority stake in a consulting firm started by a former colleague. The business model was sound, the potential upside was meaningful. She passed, not because it was risky, but because she did not have accessible capital. Her net worth is nearly $700,000. Her investable cash is under $20,000. Those are two very different realities. Equity in a house is not the same thing as capital. Capital moves, capital responds, capital creates optionality. When your wealth is entirely tied to drywall and roofing shingles, you may be asset-rich but option-poor.
What research actually suggests? A 2023 study from the National Bureau of Economic Research examined how households responded to financial shocks. The findings were clear. Households with substantial liquid savings, even if they carried mortgage debt, handled economic disruptions more effectively than households with no mortgage but minimal liquid reserves. The presence of debt alone did not determine resilience. Liquidity did. Debt can be a tool. Illiquidity is a constraint. Eliminating all debt while leaving yourself without accessible funds may feel safe, but it creates fragility. When paying off a mortgage makes sense, this does not mean you should keep a mortgage forever. Context matters. If your interest rate is high, aggressively paying it down may be mathematically wise. If you are close to retirement and value simplicity over optimization, reducing fixed expenses can lower stress. But the sequence matters. Building a strong emergency fund should come before aggressive principal reduction. 6 months of expenses and accessible savings is a baseline. Beyond that, you must compare your mortgage rate to realistic expected investment returns. If your mortgage rate is below 5%, long-term investing has historically outpaced the interest cost. That spread, even if modest, compounds over decades. More importantly, investments remain liquid. The question is not whether debt is good or bad. The question is whether eliminating it improves or reduces your flexibility. Laura did everything the debt-free narrative celebrates. She eliminated her mortgage. She owns her house outright. On paper, she looks financially secure. Yet one mechanical failure pushed her back into debt. One business opportunity passed her by because she lacked capital. Her wealth is real, but it is trapped. Financial freedom is not simply the absence of debt. It is the presence of options. It is the ability to handle emergencies without panic and pursue opportunities without hesitation. A paid-off house can be part of that freedom, but if it comes at the cost of liquidity, it may create a fragile kind of security. Wealth is not just about what you own, it is about what you can use. Before you rush to make that extra mortgage payment, ask yourself a harder question. Are you building equity or are you building flexibility? Optimize the math, but protect your liquidity. Freedom comes from options, not just ownership.